Today I want to talk about why the shorts can't cover even if they wanted to, and why they're stuck waiting for the inevitable squeeze. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So I want to start by talking about the financials, the maths and the numbers, about why these shorts are currently stuck and not allowed to close out of their short positions. Right now these shorts are currently waiting for a judgment day to decide whether they're going to be liquidated or whether they get off scot-free. They're waiting and hoping that retail investors sell off all of their AMC shares and they can close out of their shorts at this low price. But obviously if that doesn't happen, they will end up being liquidated. So let's assume these hedge funds start their portfolio with a 2x leverage ratio. They go out and they borrow $5 trillion from these major banks and they have a total portfolio value of $10 trillion. Now, as I've said before, we know the majority of this portfolio, or the majority of these portfolios, are built on long positions. Yes, they do have some short positions and even some illegal short positions, but the majority of their fund is long on the overall market. We know that AMC currently has a market cap of $5 billion. Even if there's 5 billion shares and the float is sold 10 times over, that's only $50 billion of their overall $10 trillion portfolio. Even if you assume all of these shorts have been shorting from $70, that's only a total position of $350 billion. Even if you factor in GameStop and all of the other meme stocks on top of that, maybe it's only $1 trillion out of this total $10 trillion position. And as I said, those shorts and those illegal shorts are going to be shared between a number of different funds, just like this $10 trillion value is the accumulation or the cumulative value of a number of different hedge funds. We know that realistically these illegal short positions are, say, at maximum only 10% of their overall fund values. The remaining 90% is long on the overall market. Now, obviously, if a hedge fund loses 50% of this $10 trillion, they've lost all $5 trillion of their own personal cash, but they haven't yet lost a single cent or a single penny of the bank's money. This is actually the point in which these hedge funds would be liquidated because these banks don't take on losses. Therefore, as soon as they lose 50% or 51% of their overall fund, this hedge fund or these hedge funds would be liquidated. And that works the same for you and I as well. If you're trading on margin and you're using a 2x margin or leverage ratio and your position declines by 50% or even 49 or 51%, your position will be liquidated. And that works the exact same way for these hedge funds as well, because obviously the major banks don't lose money. They will forcibly liquidate hedge fund positions before they lose a single cent. But also remember, these figures are only an example because many of these hedge funds use a leverage ratio much larger than 2 to 1 or 2x leverage ratio. For example, we know that Citadel uses a 7x leverage ratio. If Citadel had a total fund size of $10 trillion, only around $1.5 trillion would actually be their own money. The rest of that money would be borrowed from these major investment banks. Now let's assume that right now all of these hedge funds are currently down 49% on the year so far. That's not actually unreasonable to assume, as many other hedge funds like Tiger Global are down 60 or 65%. Obviously, if we assume they're only down 49%, that means they've still got $5.1 trillion left and they haven't yet breached that liquidation point. They're hanging on by the skin of their teeth, but they haven't yet failed those margin requirements. Therefore, because this hedge fund or these hedge funds still have $100 billion in remaining margin, they haven't yet failed that margin call and they haven't yet been liquidated by these major banks. But what would happen if they haven't actually valued this position accurately? What if they're not down 49% on the year and they don't have $5.1 trillion in cash remaining? What if they've actually lost another $1 trillion? They've only got $4.1 trillion remaining and they're down, 59% on the year. Well, obviously they would have blown past these margin requirements. They're significantly below that $5 trillion worth of cash. And that means that so far these banks they've borrowed money from have currently lost $900 billion. Now, obviously, a $900 billion loss is not acceptable for these major banks. For example, Credit Suisse barely has 2 nickels to rub together, let alone a spare $900 billion they'd be happy to lose. Many of these major banks and also central banks have posted record losses so far this year. They've taken on very heavy losses in the hundreds of billions of dollars, and they're not about to recognize an additional $900 billion loss. And that means that right now these major banks physically aren't allowing these hedge funds to close out of their short positions. They're refusing to liquidate them because they don't want to recognize a $900 billion loss. Therefore, they've basically told these hedge funds, guys, you can't liquidate because we can't recognize a loss this big. You just have to sit and hope that retail investors sell their shares and you can regain some of those profits and close out your shorts with minimal losses. They're basically waiting for the market to go back up. If the S&P 500 increases by an extra 20 or 30%, all of these losses all of a sudden get erased. But obviously right now the S&P 500 is not going back upwards. We're still in that market crash territory, we're still in that recession territory, and the S&P 500 is expected to fall further. But these major banks and hedge funds are going to continue taking on heavy losses. They're not just going to be down 59%, they're going to be down 79, 89, 99 or even 100% and end up being completely all out liquidated. But you might say, Tom, surely these hedge funds couldn't mismark their positions by $1 trillion. You can't just misplace $1 trillion. That's a hell of a lot of money. Well, it turns out actually they have. And Moomoo is currently holding their biggest ever giveaway for the Christmas period. They currently have a $60,000 giveaway sweepstake, and you also receive 20 free shares worth up to $2,000 each when you sign up for Moomoo right now using the link in the description below. So this article says that banks have a shortfall of more than $1 trillion in capital, and this analyst fears the shortfall will only get worse. Now, this basically means that many of these hedge funds, many of these financial institutions and private equity houses have been misvaluing their private investments and marking them up above what they're actually worth to meet their margin requirements. This has obviously been going on for some time now, and they've basically faked a value of more than $1 trillion, which analysts feel will continue to get worse. And it says that claim may surprise those who think the US banking industry has some $2.2 trillion in capital or actual asset value, but he whittles that figure in several ways. First, he notes there's a difference between book equity value, aka the investment value, and tangible equity or real cash value, the latter of which is used by these banking regulators to evaluate solvency and determine if they meet those margin requirements, but it's a narrower definition, excluding items like goodwill and deferred tax assets. And then he also subtracts what's called accumulated other comprehensive income. Thanks to quantitative easing and now quantitative tightening, all sorts of assets have become negative return propositions for banks and non-banks alike. If the coupon pays less than the funding costs, you're losing money. And then he also marks to market the losses on loans and securities created during 2020 and 2021 for the impact of this year's Fed rate hikes. That right there is enough to push banks into insolvency. So that basically means these hedge funds have already lost this $1 trillion plus, and their investments aren't worth what they're stated to be worth. And therefore, if they sold off their positions or closed out of their shorts, they would not have enough money and the banks would take on heavy losses, which they're not prepared to do. And it's likely this figure is actually much larger than $1 trillion. This $1 trillion has been calculated based on what hedge funds and banks actually have on their balance sheets. But remember from the other day, many of these hedge funds and these non-bank institutions have $80 trillion of hidden off-balance sheet dollar debt in the form of swaps. Therefore, if on their recognized investments, their on-balance sheet investments, there's already $1 trillion shortfall, when you factor in the $80 trillion of off-balance sheet liabilities they also hold, it's likely this $1 trillion shortfall is actually much larger. And especially if you factor in this new tweet from Unusual Whales that says institutions outside of the US are also holding an estimated $65 trillion in missing dollar debt off of their balance sheets as well. So you've got $80 trillion in off-balance sheet debt from these US institutions and an additional $65 trillion in off-balance sheet debt from these institutions outside of the US as well. Therefore, if there's already $1 trillion shortfall on their on-balance sheet assets and debt, when you factor in this $80 trillion and this $65 trillion in off-balance sheet debt, it's likely this number of $1 trillion is more likely 2 or 3 or even 4 trillion. And therefore, if you subtract, say, $3 trillion from their, say, $5.1 trillion in assets left, that means these hedge funds only have $2.1 trillion left in their portfolios. And therefore, that would mean these banks have to suffer a gigantic loss of $2.9 trillion just for these shorts to close out of their short positions. And this is why those hedge funds can't close out of their short positions, and why the Bank of International Settlements is now saying the world faces a staggering financial meltdown with potential losses exceeding the total number of US dollars in circulation. Basically saying that because of this giant shortfall on balance sheet and off balance sheet, and the fact these hedge funds can't close out of their short positions or even sell off their long stocks because banks would face such ginormous losses that actually would exceed the value of US dollars in circulation. And this is why, as Hang Lu says, shorts simply can't close out of their positions at prices that retail is willing to sell at. So they're stuck because they need shares to close, but they can't close at high prices. And that is why the Wall Street Journal is saying a new bull market can't start until retail investors give up and sell their shares on the cheap. But obviously, as the wider market continues falling, even the banks themselves will get closer and closer to liquidation. These hedge funds won't just have lost 49% of their portfolio, or 50%, or maybe 60 or 70%, but they'll have lost 100% of their portfolio and the money they borrowed from these banks. And therefore, it potentially won't just be the hedge funds being liquidated, it will be these major banks and major institutions being liquidated as well. And that is then obviously when the DTCC will need to step in with their recovery bailout fund, and it's likely the US taxpayer will also have to step in and prop up these major banks. And that is why, as Bruce Wayne tweeted, he said $300 is not the squeeze. Don't be fooled. Now, this is where I actually have a very interesting question. I know a lot of us are frustrated that AMC hasn't yet squeezed, and I wonder if people are starting to stop believing the squeeze. My personal question to you is, where do you want to sell your AMC shares? Do you personally believe this squeeze isn't really going to happen and you're happy to sell your AMC shares at $30 or $50 a share? Do you want to try and wait to those all-time highs and sell at $72 per share? Do you want to sell potentially early at $300 or $200 or $100 per share? Or are you happy to hold for the squeeze because you know that it's coming, just like I do, $1,000, $5,000 or $10,000 per share, or maybe even above? It'd be really interesting to see some of your comments down below on exactly when you want to sell your AMC shares. Do you want to sell early at $50 or $60 or $30 and escape with some money back? Or do you know the squeeze is going to happen? On top of that, Gold Telegraph has also tweeted saying we're starting to see central banks limit cash withdrawals as they work on their own digital currencies, while taking on huge losses as they rapidly accumulate gold. Many central banks around the world, including the Japanese central bank, the Fed, the Swiss National Bank, the Portuguese National Bank, and a number of others, have already announced that they've taken on heavy losses this year, over $100 billion each. It seems so far this year the stock market is failing because these hedge funds have held on to these toxic short positions and their toxic long positions, and they've been misreporting and mismarking their position values. Now it's got to the point where they can't even close out of their positions and the market is still falling. And finally, I also wanted to update something from my video yesterday, because it turns out, as Tony Denaro tweeted, that preferred shares actually don't get delisted in the same way that common stock does. They actually have a completely separate set of rules. As Dominic tweeted, preferred shares can still be delisted if the aggregate market value of publicly held shares is less than $2 million, or the number of publicly held shares is less than 100,000. Preferred shares or preferred stock doesn't actually get delisted if the stock falls below $1 per share, because they don't follow procedures outlined in sections 802.02 and .03. Therefore, because preferred shares and preferred stock follow separate delisting requirements to common stock, they don't get delisted even if they do fall below $1. Preferred stock and preferred shares can actually still be delisted, but under a completely separate set of rules, and we're not at risk of breaching either of those rules. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers!